Good evening, everyone. Welcome to IQI Canada Evening Talks. It's 11 p.m. here in Canada, and we are back with our session with none other than our Chief Economist, Shan Saeed. Good morning, Shan. How are you doing?
Good morning, Yusuf. Thank you for having me again.
No, it's always a pleasure having you, and so much is happening around the world right now, whether it is related to stagflation, whether it is related to interest rates. So many things are happening around the world. And you know what? All our eyes have always been, on you, guiding us, whenever the economies are good or bad, how things are going on that. Really appreciate that. And I always tell people, you know what? You need to go and follow Shan Saeed on LinkedIn, follow him on Facebook. I see you everywhere, Shan. Again, I'm going to ask you this question maybe one more time. How do you do this, Shan? You are
I think
always there, every day in the news, almost.
I think it happens normally. I mean, people, reporters, they keep on asking me questions, and they just want to cite my interview because I'm a contrarian. I don't follow the mainstream media, so they want to hear something different that is not shared in the mainstream media. So always the reporter and the journalist, they want to hear something different that is not shared.
That's true. That's true. That's true. So, you know what? I'm going to go straight to my questions. And, again, people, if you want to go follow Sean, follow him on Facebook, follow him on LinkedIn, follow him on Instagram, and you can get what's going on around the world. Sean is every day sharing something on that. Sean, I'm going to start with something, which I saw, which is your latest interview in Star newspaper in Malaysia, talking about, no recession expected. Now, tell me something. Since a lot of the people, of course, are curious to know, is recession a business cycle or a consumer cycle? Please elaborate.
Yes, a lot of people in Malaysia they have asked me that is recession knocking the doors of Malaysia, and I said no, because recession is not a business cycle; it's a consumer cycle. When consumers don't spend, the businesses don't invest, the economy shrinks. In the last 1 month or so, I have visited many shopping malls, restaurants, and what I have witnessed in Malaysia that the consumption patterns are very strong. The investment is coming into Malaysia, and overall sentiments about the economic outlook remains quite positive. So there are three factors that I mentioned in my interview yesterday with Star, and these are the very smart way of looking at the economy anywhere in the world, not just Malaysia, anywhere. One is the restaurant business. When people are spending money, it means they have confidence to get the cash flows tomorrow. And right now in Malaysia, 75 to 80% of the restaurants are full. And as you know, with restaurant industry, 7 to 8 industries are related. It is not just a restaurant. You have, suppliers, you have fruits, vegetables, food, so many things, lighting, furniture, manpower. So I think recession is not very positive in Malaysia. I think there is no, the probability of recession in Malaysia is very low. The second variable is number of car sales. As of first quarter, the car sales went up by 12.7% in Malaysia. That really indicates that people with rising income levels, they are spending money to buy cars. It's human nature. Whenever your income goes up, whenever your salary goes up, the first thing that people want to buy is either car or a house.
Yeah.
So, a lot of people in Malaysia with increasing income levels, they are buying cars. The GDP size is going up. So, this is the second indicator that shows where the economy is heading towards. So, number one is restaurant business. Number two is car business. Number three is energy consumption. Whenever you buy a car, you need energy. You can't run a car on water. Either you need CNG, LNG, diesel, or petrol. So right now, the consumption patterns in Malaysia is the 28th country in terms of energy consumption. And post-COVID situation, we have seen the energy consumption is back during COVID situation. The energy consumption was down to 70, between 70 and 80 million barrels per day. But right now, when I speak, the daily consumption of oil globally is between 97 and 98 million barrels per day. And by
Wow.
year end, we are expecting 100 million barrels per day. And next year, we're expecting the oil consumption globally because once China comes back, the oil consumption will go between 105 and 110 million barrels per day. This is
Wow.
what we're talking about. And that's why, if you recall, in our last program, I said the oil prices for this year will be between 110 and
Yeah,
140, $150 per barrel. And for
that's right.
next year, Jamie Dimon, the CEO of JP Morgan, is saying year end 150 and $175 per barrel. That is possible, but we stick to our forecast of 110 and 150. For next year, I am expecting that oil prices will be between 150 and $200 per barrel
Oh
because
my God.
everything is based on the geopolitical risk is getting higher. US dollar might depreciate, and there will be supply constraint because of this. The It will put pressure on the oil market. So for next year, we can easily expect that oil prices will meander around 150 to $200 per barrel. So these are the three ways of looking at the economy. That's why I have attended 5 or 6 networking events in the last 1 month or so. And yesterday I was invited in a private lunch where all the private bankers were sitting from Malaysia, Singapore, and Hong Kong. And I was the only one, who was coming from a brokerage house. And everybody knows in Malaysia that I think and I talk like investment bankers. And investment bankers are quite analytical in their approach. So most of those
Yeah,
private bankers from Malaysia and Singapore and Hong Kong, they were listening to me quite attentively, and they were nodding their heads, acknowledging that what Shan is saying is making some sense to them, and it makes some logic. And I was talking about stagflation call, about the risk that we shared last year, and now in April we talked about recession coming in advanced economies, and then we will have a reversal. So I think these are some of the three variables of looking at the economy, not in Malaysia, but anywhere in the world. You can apply even in Canada, Australia, UK. So you have restaurant business, you have car sales, automobile sales, and you have energy consumption. These three variables, they give good insight what is happening in the economy, what is the consumer sentiment, or what is the pulse of the economy.
that's true. That's true. That's true. We are live with Shan Saeed. Nitali, thank you so much for joining us. Got a message. Hey, Shan. Thanks for sharing your good insights. So we are live with Shan. If you have any questions, please feel free to contact us anytime. That. So Shan, 150, $200. Oh my God! It's you're saying in terms of the oil. That's we already talked. We're talking about 110, $150 by the end of the year. 150, $200 on that. Wow, that's that's going to be again. But what the points you right now mentioned in terms of the consumers spending their money, that really shows where the recession will be coming or not on that. My question number two to you is that the Wall Street Journal dated June 24, and what I'd like to do is I'd like to share screen as well on that. On the June 24, 2022, lawmakers pressed that Federal Reserve Chairman Jerome Powell has over how the central bank would manage trade-offs it could confront if its interest rate increases, slows the economy sharply, but don't reduce inflation quickly. Can Fed contain the inflation this year? What do you think?
Uh, Yusuf, at this point of time, what you shared about the Wall Street Journal, I read that news. Uh, I think that is another slide. Yes, this
Yeah,
slide.
yeah,
Uh, So I think by next month, Powell will raise another 75 basis point, and we expect that interest rate will touch 2.25, because right now, sorry, interest rate will touch 2.25. Inflation is over 8%, and inflation continues to show its head in advanced economies, and that's a real systematic risk. If you recall, in July last year, we shared about four risks that are coming to the market. The first was the systematic risk, and in systematic risk, we were talking about the interest rate hikes that are coming, and the inflation numbers are getting stronger, and they're getting real, and they're getting serious. So I think inflation remains hot, and that's why Fed wants to increase interest rate at this point of time. So I think globally, what is happening, the big four central banks, that is Fed, ECB, Bank of England, and Bank of Japan, they're all in sync that because inflation is getting serious, interest rates will go up, and we are going into higher interest rate regime era, and this interest rate hike will continue for the next year or so. This clearly shows that the central banks are quite serious to contain inflation. It will not happen overnight. It will take some time. So I think inflation will remain high for the next 2 years, and then the global economy will recover by 2025.
So 2024, 2025, we're looking at 2 years for the recovery or getting stable.
I think 23, 24, the inflation will, the central bank will try to control inflation. Uh, it might happen if inflation will come down, but I think by 2025, we expect that global economy will recover. Yes, there are many variables, exogenous variables that are coming into play, but eventually, I think inflation numbers are going to stabilize and global economy will hopefully recover by 2025.
So Sean, that brings me to my other question that you made the first call in market in 20 November 2020 about stagflation. The president of World Bank made a similar comments 2 weeks ago. Uh, what do you say about that? Here it is.
Yes, this is a big call. I still remember November 2020 when we shared, and I shared with a lot of people globally in Malaysia, in Singapore, and in US. They said, Shan, this is an outlier. This won't happen. I said,
Yeah.
but there's a saying in English, a person is known by the company he keeps. I sit
Yep.
with people who are smarter than me, and they have given me this insight. And I was invited in September 2020 in a webinar, a Zoom event by Stanford University alumni. And during the discourse of that webinar, one of my friends who's graduated from Stanford Graduate School of Business, he said, I foresee stagflation, and the chances of stagflation, the probability is between 70 to 80%. So I spoke to Saad and I said, Saad, I think I will put that in my newsletter in November. So now the president of World Bank,
No.
David Malpass, is sharing the same in June 2022. So we were 20 months ahead of the mainstream media and many global players. And now the world is coming to realize that 1970 is back. Stagflation is here to stay. And during stagflation, most of those sophisticated and smart investors, they took position in real estate, gold, and silver. So I think it's a big call. People who follow our newsletter, they can highly leverage from this, insights that we share about global markets, about various countries, and they can leverage this information for their financial benefit and in order to make strategic decision for their asset portfolio, investment portfolio, so that they remain ahead of the curve. So I'm grateful for my networking that we made the big call, and because of this big call, many people are now realizing that IQI is quite active and they are quite ahead of many people and many players.
Absolutely, Sean. As you rightly said, you made that call in November 2020, and now we're seeing the stock question coming up on that. So, for all our audience, we're live right now with Shan Saeed. If you have any questions, please do ask us. Do put in your comments. Even after the show, live show's over, do let us know any questions you guys have, and we would like to get back to you and let you know. Again, follow Shan on LinkedIn, on Facebook, and on Instagram for the latest economic updates, not only for Malaysia but around the world as well. Having said that, I want to bring in the Canadian real estate market. I mean, this came in Economist magazine, which I have captured as well. And let me just look at this chart over here. That for our discussion, that you have inspired, to pursue economist and found the gap interesting for my sophisticated and smart investors who follow us here in Canada. Since 2000, the average home price of Canada has more than tripled in the same time period. For example, again, there are different numbers. Americans have risen by 20%, by 60% in OECD. Only in New Zealand has been a faster increase related to the incomes of this century. What do you have to say about this chart, Shan?
Thank you, Yusuf. I am so happy that I have inspired people that they are following Economist magazine. And as I always said, when I was studying at University of Chicago, most of the economic and finance professors they were carrying Economist magazine, and it's quite informative and insightful because they collect data, and data has become quite supreme and very important for most of those sophisticated and smart, and it is all numbers. Numbers don't lie. In English they say numbers don't lie. And
That's
this
right.
chart clearly indicates the interest global investors have in Canada. And as I have been sharing with you, Canada has done a remarkable job in terms of branding herself. When
Yep.
people talk about Canada, it's about stability, it's about lifestyle, it's about education, healthcare. Advanced country, first world country, first world services. And this chart from Economist magazine, I'm glad that you are sharing. And I hope your sophisticated and smart investors who are following you in Canada, they can, leverage from this that how Canadian real estate market has performed over a period of 21 years. So do you have the numbers in front of you? Did you
Oh
calculate
yes,
the numbers?
oh yes. I did actually. Canada Canada 225%, UK 205%, France 100%, USA 53%, Germany 47%, Italy 3%. In fact, Japan negative 25%.
So, Yusuf, if you are saying Canada is 225% in a span of 21 years, that means Canada, on the average, has delivered around 10.7%, 11%. Am I right in saying that?
That's
To
absolutely correct. Yes, absolutely correct. Just to add to what you're saying, Shan, recently on our Toronto real estate market update, which we get every month, so we have seen an increase of approximately 9.5% from May 2021 to May 2022. And you're right at that point of 10.77, 11% increase.
So I think what you are sharing, I think it illustrates the market is very hot. Investors have got huge interest, despite interest rates have gone up in Canada. They are at 1.5, but still the interest is there. And what you are sharing, 9.4%. This is the period between COVID, during COVID, and post COVID. So you
That's
can
right.
well imagine that despite COVID, investors have come to realize that real estate is the new global currency, and investors are taking position in tangible assets. Look at the equity and bond markets, they are getting the pounding. And look at Bitcoin, it have gone down like I don't know where the Bitcoin is right now. It must be under the ship. But it's very healthy. I think what you have shared is quite informative, and as I always say, that numbers don't lie. 9.4% in this pre-COVID situation, I think it's simply fabulous. And I think you can share these slides with your valued investors so that they can leverage from this and they can understand what is happening in the market. So Canada delivering 225% in a span of 21 years, and what we have done, a quick maths, 10.7,
Yeah.
11%, I think, and what you are sharing is 9.4. So I wouldn't be surprised if the market continues to show an upward momentum, and there could be strong interest not only from locals but also for global investors, because everybody has got access to Economist magazine, and they can see that Canada is way up than Britain or UK, sorry, US, or even Germany or France and Europe. I think Canadian market remains hot. Again, it boils down to countries' branding. It boils down to lifestyle. It boils down to education. It boils down to healthcare. And most importantly, one factor that we have been talking in Malaysia, and why economies will upsurge post-COVID situation is macroeconomic stability. What is macroeconomic stability? When you have political stability, economic stability, and financial stability for investors, that is very important. Look at Malaysia. 1st April, the economy opened. We have over 2 million visitors, tourists coming to Malaysia, and
Wow.
June has not even ended. And the
Yeah.
tourism minister said that we are targeting 4.5 million tourists. I think Malaysia will exceed that number because of macroeconomic stability, because of lifestyle. Again, just like you Canada has, so I think macroeconomic stability has become the hallmark for many economies, and those economies that are on the upsurge, they will continue to get investors, and they will continue to have strong consumption patterns, and that will remain a key variable for successful and non-successful economies.
You're absolutely right. When it comes to the Canadian real estate market, especially, I'll just say that, a lot of people we've been, as you rightly mentioned, the interest rates are going up. But when we look at the overall situation in terms of the real estate, the one thing which we have seen overall in terms of growing up or a business perspective or for people investing into it is real estate. Uh, Again, population 1.2 million expected people still have not come up, not even like half of them are still here. Yet we have them coming in. We have international students who come here. They graduate every year. They get their work permits, and the first thing they get their PR card is they want to go and get into a property on that. Having said that, demand and supply wise, there's not enough housing which is being built right now as compared to supply side of it. And Chan, interestingly, right now the rental market has become very, very hot right now. That people are willing to go and pay a full 1 year upfront on a $3,000, $4,000 rental of a property on that just to secure that particular unit and that particular house on that. That's how it's going on. And one thing I always relate, as you rightly mentioned about real estate, is the end consumer or the population which is coming in, and that's what we are seeing every time people are coming in. People would like to rent it out, maybe in the first year, and some people are actually coming up already prepared because we have the financing options of you put 35% down payment as a new immigrant, you can get your financing done on it on that. So, very, 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 great insight on that. Thank you for that. And I think we will see to have this continuous growth. Although we've been getting a lot of news from everywhere because the interest rate is going up on that. But I always look at real estate. It's a cyclic adjustment which happens on that. And even in this time when we are seeing it's going a little bit slower down as compared to what we saw a few months ago, the properties are still moving, and it's a good time for the buyers or the investors to get into the market right now, because what we will see in future, with the people coming in, we'll just see a growth.
Yusuf, one more point since you are talking about the rental market. One of the biggest sovereign wealth fund in Singapore globally, GIC, they took position in London students rental market. And this is, I think 3 weeks back, it came in Financial Times that Singapore's the sovereign wealth fund, GIC, they have parked 3 billion pounds in London rental market. So rental market globally, not just Canada, but
Yeah.
globally is getting hot. So what you are
Wow.
sharing that people are willing to give an upfront 1 year deposit, even if the property is the rental is costing 3,000 to 4,000,
That's right.
they are still willing to pay 48 or $50,000 for 1 year rental. It clearly indicates that the consumers, the investors, or the buyers who are going into this market, they are aware that the rentals might go up, and this is the best time
That's
to
right.
take position before the rentals go up further. So I think not only this, Qatar Investment Authority,
Hmm.
uh, 3 weeks back, again it came, they bought 32 office units in Japan.
Wow.
Japanese market right now is very slow, so it's very depressed. So that there are fire sales going on globally. Qatar Investment Authority, which is one of the biggest sovereign wealth funds globally, they have taken position in Japan, but they have also taken position in Singapore's. office building called Asia Center. They've also taken position in UK real estate market. So I think the next 3 to 5 years, I foresee that sovereign wealth funds, family offices. Even yesterday, when I was invited to this lunch by the private bankers, the discourse was roaming around real estate market. It was roaming around the tangible assets. So I said, we have written this book, Real Estate, the New Global Currency, and it is available on Amazon. And it's absolutely free. You can have a look
Yeah,
and you can read it. So I think more and more discourse and discussions are revolving around real estate, tangible assets. Investors are feeling the pinch. They're feeling the heat of the equity and bond markets, and with rising interest rate regime globally, I think most of those investors who understand history and economics, they will go into tangible asset, and this is quite significant. And not only this, when family offices again, they are over 5,000, 6,000 family offices. They control around 9 to 10 trillion dollars of wealth globally. I think if family offices they move into real estate, I think there will be a significant shift and signal that investors should park their fund in real estate, and that is a protection, uh, a hedge against inflation. And real assets, they can provide you a hedge against inflation. Other assets can, but they will remain under pressure in the next 2 to 3 years.
that's right. That's right. So we are live with Shan Saeed for all of the listeners right now. If you have any questions or comments, do type it in the comment box right now. Shan, I want to go to our finally the question is that Fed is expected to raise 75 basis points next month, which is July. Do you foresee happening in Canada and other advanced economies? Is it going to be 25 basis point or 50 basis point on that? Please share your insight.
Yes, Yusuf, Fed Chair Jerome Powell has already mentioned that he's going to raise interest rate by 75 basis point because inflation is now getting very, very serious and real, not only in US but many advanced economies. So I think we are heading for higher interest rate regime. By year end, we are expecting the US discount rate to be to between 2.5 and 3%. Canadian central bank, they have already raised the interest rate to 1.5, and
Yeah,
if inflation remains higher, they will try to tame that inflation with a 25 basis point hike or 50 basis point hike. Same goes for Bank of England, same goes for European Central Bank, and same goes for Bank of Japan. These are the big four central banks. So once these central banks they hike interest rate, they will send a clear signal to the market that they are serious in controlling inflation, which has got out of hand because of a post-COVID situation and geopolitical risk. But eventually, as I said, global economy will recover by 2025. Inflation will eventually come down. It's not like inflation will remain high for the rest of our lives.
yeah,
Eventually, the hike in interest rate will make an impact, and every hike, whether it's 25 or 50 basis point undertaken by the central bank, it takes good 12 to 15 months to make an impact on the economy. So a lot of people they expect that when central bank they raise interest rate by 25 to 50 basis point, inflation will come down in 1 month's time or 2 months time or 3 months time. No, it is a cycle. It works in a cycle, and that's how it makes an impact. Because once the interest rates go up, the extra money that is outside the system, it comes back into the system. The consumption pattern they slow down. Obviously when
yeah.
consumption patterns slow down, the growth takes the impact. Once the growth takes an impact, obviously everything slows down. So it's a cycle, it moves in a cycle. So in my opinion, the way I foresee things, central banks globally, as of today, 38, 39 central banks have hiked interest rate globally.
Wow.
38, 39 central banks have hiked interest rate globally, not just Canada or US or Pakistan or any other country. Many central banks are hiking interest rate because inflation is going up globally. And in order to contain inflation, you only have two monetary tools. Either you hike interest rate or
Yeah.
you let your currency becoming stronger. What the US is doing is one of those strategies. If US dollar gets stronger, obviously, it takes care of the import bill. Imports gets cheaper, and the benefit goes to the consumers because they have to pay less for the imported item. And since US is the largest economy of the world, consumers are always under pressure because if US dollar depreciates. So I think, in my opinion, inflation will remain high for the next 2 years, but eventually it will come down. And what we have been sharing in the market, the global economy will recover by 2025.
Great, Sean. Thank you so much. Always a pleasure having you. So much insight. So many questions which come to our mind. So many questions come to our sophisticated investors. But what I like to tell my investors that always stay up to date with Shan Saeed. That's how we work with our investors. We give you the market insights. Very important to understand what could happen next, rather than it just, blindly going and getting into, I would say, other kind of so-called cryptocurrencies and the market, just invest
Yeah.
into the real stuff, which are always something you can get your whole hands on, land, real estate, gold, silver, take position in that. Shan, thank you so much. Would you like to say anything else to our audience before we say bye to them?
Thank you, Yusuf, for all those comments. Yes, I would say the markets will continue to stay volatile. And in these tempestuous and in these tumultuous times, the only fixed asset that goes up is land. So protect yourself, hedge yourself against inflation, hedge yourself against market uncertainty, hedge yourself against bazooka that is coming to market. And if you want to have peace of mind, take position in real estate. Real estate is a new global currency, but stay away from fancy assets, that can destroy your peace of mind and you might be having sleepless nights. So, in order to avoid sleepless nights, you should take position in real assets and stay ahead of the market with IQI always. Thank you so much.
Thank you, everyone. Remember, take position in real assets. Thank you very much, everyone, for joining us tonight. If you have any questions or comments, do let us know. And, Sean will be back again next month. If you're looking for a specific topic or a question you want us to discuss about it, do reach out to us before, and I'll try to, ask Sean to talk about it next time as well. With this note, thank you, everyone. Take care of yourself. Thank you, Sean. Have a wonderful day. Bye bye.
Thank you. Bye bye.